right. Well, we got a small group this evening, which sometimes is nice. So you guys shouldn't be afraid to ask questions. And I do a lot of these. This is actually the third one this week that I do. I travel to different libraries across Long Island, different businesses, in a lot of different settings. And I always tell folks, please don't hesitate to ask questions. That's what makes these things impactful, I think, for the guests that attend is the questions that get asked. And in a small group like this, you should don't be shy. So my name is Matt Wilkow. I'm a partner and a registered financial planner with the Legacy Group. We have 3 offices, one that's in the building literally right next door. We have another office in Syosset, and then we have an office in the city. And today's class seminar is about planning for college. So it's going to kind of talk about college mainly through a financial lens, understanding what the costs of college are, what we expect to happen to those costs, ways that people fund college, and then get into some of the specifics of the different vehicles that a lot of folks use to make sure that college education can be paid for. So before we get started, just a little disclaimer. I've been doing this for a long time, and I've seen I've worked with hundreds, if not thousands of different clients and helped them with everything from financially planning for college to retirement to managing their businesses and to everything in between. High net worth individuals, normal folks. What I can tell you is that no 2 clients are the same, no 2 financial strategies are the same. So for us, it's very difficult to try to produce something that's cookie cutter and that we can broadcast out to the masses. But that's really what we're accomplishing with this. So that being said, the disclaimer is, don't necessarily take everything that you see here as personalized advice for you, right? You really got to work with an advisor and kind of understand what's the best strategy for you. And certainly don't make any legal or tax changes based on what you see here without, talking to a professional one-on-one. Right. So the agenda for today, the first thing that we're going to talk about is understanding college costs. Right. The second thing is how can we fund college? What is it that people do? And what are the pros and cons of the different vehicles that we all have available to us out there? We're going to talk a little bit about financial aid. This is probably the topic that can get most intricate, especially when you get into the government financial aid that's offered. So today is not necessarily meant to be an extreme deep dive on financial aid, but more of a general overview. And then we're going to end with other considerations and any questions. But since we have a small group today, don't hesitate to interrupt me or ask questions as we go along. So let's first talk about understanding college costs, right? What you see here shows that over the last 10 years, right, what has happened with tuition costs in both 4-year private schools as well as public schools. And what you can see on the left is for a private nonprofit 4-year degree from 2008 to 2018, it has risen in cost by 17%, which has outpaced inflation. So it's getting more expensive relative to everything else in our economy. Right. The same is true of a public 4-year degree, and from 2008 to 2018, it's increased by 15%. I think the stat isn't here, but I think it's about that over the last 30 years or so, tuition costs have increased year over year by 5%. Inflation over the last 30 years has increased by 2 to 3%. So the cost of college is moving at a pace double what everything else is. Right. So it can be a very, very expensive endeavor. So the earlier you can start doing planning for it, typically the better. So what does that mean in terms of total cost and from a budget perspective? What should I expect as I go to college? What should I expect to pay? Well, what we can look at is averages. And what you see here is the average total 2020 cost for 1 year of college. And on the left, you see a public 4-year in-state school. So since we're in New York, it would be an example here would be like a SUNY school. Where it's roughly $22,000 per year. Then in the green, you'll see a public 4-year out-of-state school. So if you go, like if somebody lived in New Jersey and they went to a SUNY school, on average, they'd be paying around $38,000 a year. And then lastly, you have schools on the right. These are private schools, and their tuition cost averages around $50,000. It doesn't mean that it can't be more or less expensive. So what this shows is nobody has a crystal ball and nobody knows what's going to happen to tuition costs over the next 15 years. But there is a lot of data out there that experts can kind of analyze, and they can put together projections to say, what they anticipate the future cost of college to be. And what you can see here is on the that line at the very top, the orange line, that's private nonprofit school, where right now it's about $50,000 a year in tuition costs. 15 years from now, they're expecting that to be around 60 to 65,000. Right. And then for the green, which is public out of state, it's around 38,000 today. They're saying it's probably going to rise to about 48. And the blue is public in-state schools around 22,000. They expect it to rise to about 28,000 15 years from now. Right. So essentially 5% each year. So now the big question is, and why most people, take the time to kind of look into planning for college, what they're talking about is, how can we afford to pay for this? And what are the different things and strategies and vehicles that people use in order to pay for it? So a common way to look at it for a lot of folks, and again, there's no right or wrong answer here. Everybody's situation is different, but a lot of folks kind of look at it in a third, a third, a third. And what that means is that they're going to use savings to cover a third of the tuition costs. They're going to use their income to cover the other third, and then they're going to use loans to cover the last third of it. So let's jump into the first one, which is savings, right? If you wanted to start saving in advance of going to school, and the earlier that can be done, typically the better the result is going to be. What are the different vehicles that are out there that you can utilize? So the most common one that I think most people hear a lot about when you talk about college savings is a 529 plan. Hi, how are you? Yeah. Give you one of these. You're welcome. So one of the most common ones that you hear is a 529 savings plan. We're going to get into the specifics of a 529, the pros and the cons of it. Another one that used to be more popular in the past, but we don't really see a tremendous amount of activity with this vehicle anymore, is a Coverdell Education Savings Account. We'll talk about that. And then the last one is a bank and investment accounts. These are just general saving and investment vehicles that can be utilized to pay for tuition. So let's first talk about a 529 college savings plan. Right, so it's a tax advantaged investment vehicle. So we're going to talk about what that means. It's used to pay for qualified higher education costs and higher education costs only. We'll talk more about that as well. And it's administered individually by each state. So rules vary state to state. It's the state that you live in. It's not the state you go to school. So if you live in New York, you have to follow the 529 New York rules. That doesn't mean you can't go to a college in New Jersey or California or where have you. You're not a resident of that state. You're a resident of New York. Let's go through the specifics of a 529. Earnings and distributions are tax advantage. So what does that mean? So to give you guys an example, let's just say that you start saving into a 529 when your child is very young. And let's say over the course of the 18 years, up until they're 18 years old, when they're ready to go to school, you've saved collectively $50,000 into that 529, to use a random number. And let's just say because of market performance, that account has grown to 125,000 in value. Right? So you put 50,000 in, but the value is now 125 because the stock market has done well over the 18 years that you've been funding this vehicle. If that was any other investment account outside of a retirement account, if you went to go sell the 125,000 when the child is ready to go to school, you would have to pay taxes on the gain. What is the gain? Right? You put 50,000 in, it's worth 125, so there's a $75,000 gain. So you would have to pay taxes on that. It's capital gains tax. Capital gains tax varies, but for most folks, it's 15%. Right? So that roughly is $22,500 in taxes. Right? So your 125,000 after taxes is now roughly 100,000. With a 529 plan, what the government essentially does and what the IRS does is they say that as long as you use that money to pay for education, we're not going to tax you 1 penny on it. So instead of paying the 15% and losing $22,500 in taxes in this hypothetical example, you pay zero. Right? So from a tax perspective, it's very beneficial. Anybody can establish a 529. right? It doesn't, there's certain vehicles out there that the IRS will say if you make too much money or if you're above a certain income threshold, you're not allowed to participate in a vehicle like this. 529, that doesn't matter how much wealth you have, doesn't matter how much income you do or don't have. Anybody's allowed to set up a 529 plan. Contributions are considered gifts for tax purposes. Distributions can only be used for qualified college distributions can only be used for qualified college expenses or taxes and penalties may be incurred. So this is probably one of the biggest reasons why folks sometimes are apprehensive to do 529 plans is this reason right here. Because let's go back to my hypothetical example. You've done a great job saving, child's 18, you have $125,000 in the 529 plan, and they decide they don't want to go to college. Well, what do you do? Well, if you decide to take that money out and use it for anything else outside of education, you're going to have to pay the taxes on it, but you're also going to get levied a 10% penalty. So a 10% penalty in that situation would be $12,500. So you would have a $12,500 fine, essentially, that you'd have to pay. And then on top of that, you'd have to pay the $22,500 in taxes. So it can be, it's not great if I put it in layman's terms, to use the money for anything but education. And that being said, that doesn't mean that if maybe you have another child, maybe the next child goes to college, so you can change the beneficiary on the account. Even if you don't have another child, if you have some other family member, a niece or a nephew or a cousin, it doesn't really matter. You can label them as the beneficiary. And there's no time limit on it. So it doesn't mean that even if your child doesn't go to school when they're 18, if 10 years later at 28, they decide they want to go to school, it can be used at that time. And it's not just traditional four-year education. You can use it for trade schools. It can be used for anything tied to education. So, I mean, the expense for books, for classes, it can be used for that. It can be used for room and board, meal plans, all those kinds of things. Anything that could be tied to an education cost, essentially, in most situations qualifies for a distribution, right? But it has to be used for education or something tied to education. And then it can be switched to another beneficiary, like we just said. So let me pause there, because when we talk about college planning, 529s are really the biggest topic of conversation. Any questions on 529s and how they work? Yes, sir. Yes. You can. So it's a state where you're a resident of. So your child, you and your child are a resident in New York, they can go to school in any state that they want, and you can use that money to pay for the tuition. It's only tied to the state that you're a resident, not where the child goes to school. As far as international is concerned, that's a really good question. I think the rules are a little more convoluted when it comes to going to a school out of the country. I'd have to follow up with you on the specific there, and that's something I think they've changed it recently too. So that's a good question as far as international is concerned. Any other questions? So now let's talk about the Coverdell Education Savings Account. Like I said, these used to be more popular in the past. Don't really see a lot of folks doing these anymore. It's a tax advantage investment vehicle similar to the 529. It's used to pay for qualified elementary, secondary, and higher education costs. So let's get into the specifics of it. And I apologize. Let me just back up for a second here. One more thing to talk about with the 529 plan is that any of the money that goes into the 529 plan is tax deductible for New York State income taxes. We don't have it listed here because we do these presentations sometimes outside of New York. But because everybody here, I presume, lives in New York, I'll talk about it. So New York State allows you to deduct up to $10,000 per year for a married couple, $5,000 for an individual, for contributions to a 529 plan. So let's go through another hypothetical. Let's just say between myself and my spouse, we make $100,000 a year. And we take $10,000 and we put it into our child's 529 plan. New York State income taxes range somewhere between 4 to 8%. For somebody making $100,000 a year, it's roughly about 5% is what the tax is. So that means that they're paying $5,000 a year every single year in income taxes to New York State. I'm not talking about federal taxes, state income taxes. So by putting $10,000 into the 529, our taxable income just went from 100,000 to 90,000. So instead of us paying $5,000 in income taxes this year to New York State, we pay $4,500. So essentially we saved $500. So what did it really cost us to put the $10,000 into the 529? It didn't cost us $10,000. It really cost us $9,500. So it's a tax deduction for New York State. You can't do more than $10,000 for married couples. As you can put more than $10,000 into the 529, you just can't deduct it for tax purposes. Does that make sense? All right. Now back to, sorry for jumping around, back to the Coverdell education savings. So it's post-tax contributions only. So there's no tax deductions when you put money in a Coverdell education savings account. It's tax deferred growth and tax-free withdrawal. So everything I just mentioned before about the 529, you put 50 grand in, it goes to 125. You can take all 125 out and use that to pay for education, and the government's not going to tax you 1 penny on it. This works the same way. Annual contribution limit of $2,000 per beneficiary until age 18. I think this is probably one of the biggest reasons why people choose to do the 529 over the Coverdell education savings account, because we just went through an exercise showing how expensive college is. Saving $2,000 a year, you know, even if you started when your child is a baby, it's probably not going to be very impactful. Distributions can only be used for qualified education expenses or taxes and penalties may be incurred. So it's the same as a 529. If the child doesn't go to school, and you use the money for something else, you're going to get hit with taxes. You're going to get hit with penalties. You can switch to a beneficiary to a different family member, just like the 529. And generally, and this is another big difference between this and the 529, unused assets transfer to the beneficiary automatically at age 30. So what this means is that if my child doesn't go to school or I don't use this for whatever reason, right, on my child's 30th birthday, whatever the amount of money in this account is automatically going to go to them. And it's going to most likely incur taxes and penalties at that time. So it's a lot more restrictive than the 529, which is, I think, one of the reasons why a lot of folks opt to do the 529 over this. Any questions? So let's talk about personal savings. So all the things that are listed here are not unique to college education. Anybody that wants to save money can save money into any of the vehicles that you see here, right? Well, we'll talk about why some people choose to save money into these vehicles over a 529 or a Coverdell savings account. So you can't just put money in a savings account, right? This is just money in the bank, right? It's not really growing at a high rate. The interest rates are very low, but you sort of essentially keeping it in cash. You can do that. You can put money in CDs. CDs as well. You know, rates are better now than they were for the last 20 years, but they're still relatively low. Most CDs are paying somewhere between 2 to 3%. Money market account is really just a glorified savings account. They're currently paying around 1.75-ish%. It's completely liquid. It's almost like having a bank account. It's really just a high yield savings account is all it is. Investment accounts. So you can just take money. You can open an investment account, you put money in it. There's no tax incentives for doing it this way, but you can invest it like any other investment account, and you can use the proceeds of that investment account to pay for education costs. And then you can use individual retirement accounts. Here's where I would say, proceed with extreme caution, using your retirement account to pay for your child's education, because what you definitely don't want to do is sacrifice your own retirement for the sake of child education. And it's not even a question of, well, I'll do anything for my child and I'll sacrifice myself. There's other options that we'll get into in a minute when it comes to education. You can take loans out. You can't take loans out to support your retirement. And the cost of your retirement is going to more likely than not be significantly more than an education cost. So it is not advised to use retirement assets to fund a child's education unless you're in a really, really good financial position and you have more than enough money saved for retirement. Retirement's not going to be a problem for you. The government does allow you to take money out of your retirement accounts. You'll have to pay taxes on it, but you won't get penalized, and that can get used for education costs. So I want to go back to the investment accounts for a second. So, because I've been doing this a long time and I've helped a lot of people with planning for college education, what I can say is that when we go through the 529 with them, questions come up and say, well, what if my child doesn't go to school? I don't want to be in a position where I have all this money in this account and I can't use it without paying penalties. Even if your child does go to school, for example, I have a 4.5-year-old myself, right? I have no idea in 14 years if she's going to go to, NYU that costs $75,000 a year, or if she's going to go to SUNY Binghamton, which costs 18. And, that's a big difference in price. So how, for me, from a funding perspective, how do I know how much money each year to put into my daughter's 529 when I have no idea what the cost of her education is going to be in 14 years? So it becomes a difficult situation where if you potentially overfund your child's 529 and then they go to a school that's less expensive than maybe what you anticipated, and now they've gone through their 4-year education, you've spent all the money and there's still money left over in the 529, you can't use that money for anything else but education. So it creates flexibility issues. So with investment accounts, right, there are no tax incentives, right? The reason why you would do the 529 is that you want to save that, in that hypothetical example I drew out, you want to save the $22,000 in taxes, but you're sacrificing flexibility to save that money. So some folks decide, you know what, I'd rather potentially lose the $22,000 in taxes in the future when my child goes to school, but have the flexibility that I can use that money for whatever I want, whether it's for my child's education, I could use it, I could take the money back and use it myself for my own retirement or what have you. You have flexibility. And a lot of folks, they do both. A lot of folks will fund 529s and investment accounts, so that way they don't get into a position where the 529 grows too big and they potentially have too much in there and they got too much money than what the education is going to cost. There's a lot of different ways to do it. There's not a right or wrong answer. It really comes down to what you're comfortable with. And it also comes down to your tax situation as well. Let me pause there. Just threw a lot of financial stuff at you that for me, this is another day in the office, but for a lot of folks, this might be the first time you're hearing things like this, and it can be a lot to take in. Any questions? Yes. So that's a whole separate other conversation, but I will give you an answer. Typically, the general rule with investing is that the closer you get to the date of actually needing the money, the less risk you want to take. Right. So, conventional wisdom tells us when we save for retirement, as we start getting older and as our retirement date starts approaching, we want to scale the risk back. Right. So this is no different. Right. If I just had a baby yesterday and I set up a 529 for them, I can invest that aggressively because I know they're not going to college for 18 years. I have an 18-year runway. I can invest it aggressively, but it needs to be monitored so that over time, as they start aging, the risk starts getting scaled back, because what you don't want is a situation where your child is 17 and you're going to need the money in 6 to 12 months and the market drops 30% and you take a 30% loss. And now you have to sell at a substantial loss. You don't want that. So from a risk perspective, asset allocation perspective, it needs to be really closely monitored to make sure that the risk is being scaled back as the date to school is approaching. As far as for investment options are concerned, you have a lot of flexibility. So you can invest in equities, you can invest in bonds, just like any other account, just like your retirement account or any other investment account you set up, you do have a lot of discretion over what investments. Most folks in New York State offers a 529 plan that's very simple to enroll in. You just go to the state website. It takes literally like 10 minutes to enroll, and they have a automatic program that you can enter like the date of birth of your child, and it'll automatically scale down the risk as time goes on and they get closer to age 18. That answer your question? Any other questions? So this one is pretty self-explanatory. You know, some folks, when it's time for the kid to go to college, they just pay out of their own pocket, right? And it just becomes another expense in the monthly and annual budget of the household. One thing to note with it is that if you are paying out of pocket for education, sometimes there's some income tax credits that apply. So you save some money on taxes. Government tries to help you out a little bit if you're going to do it that way. It's pretty self-explanatory. You're just paying for it as you go. Here comes the most complicated part of how to pay for school, which is loans. There's private loans, there's government loans, and then there's what's called permanent life insurance loans. Let's first talk about private loans. This is the easiest one to talk about. Private loans, just like any other loan. If I want a loan, I go to a bank. I can negotiate an interest rate with the bank. I can negotiate a term of the loan with the bank. They're going to check my credit. If I have good credit, I have a good chance of getting a loan. If I don't have good credit, I probably am not going to get a loan. And whatever I can work out with the bank, I get a loan, and that's it. Right? It's pretty, you know, it's self-explanatory to some degree. Where it becomes a lot more complicated is with government loans. Right? So government loans are, of course, funded by the federal government. You apply via the free application for federal student aid, also known as FAFSA, right, which a lot of us have heard of. And why people would go through the because this of getting a government loan is typically a lot more tricky than getting a private loan. So you might ask the question, well, why would anybody get a government loan? Why don't you just go private if it's easier? Well, the answer is that if you do qualify for government loans, typically there's going to be a lot more favorable interest rates and repayment options. Right, so if you do qualify, it's definitely more often than not, I'll say it's in your best interest to go the government route. Yes. Yes. Yes, absolutely. It absolutely favors lower income. And, you know, and we'll get into that in a second. It's not only just income, it's also assets. So even if you don't have a high income, right, but you have a lot of money in the bank, to put it frankly, you know, that can affect your ability to get a loan as well. That's a great question. So it comes down to income and assets. So if I have a rental property that's yielding me $20,000 a year of income, well, that's just extra income that I need to mark down on my FAFSA application. And if my income's too high, that might affect my eligibility to get a loan. Also, since I own the real estate, whatever the value of the real estate is, if it's a $500,000 home I own, or if it's a $2 million home I own, I have to list the value of it. And if I am shown to have too much assets, that can affect my ability to get the FAFSA loan. Businesses is the same way, right? If I own a business and that business is valued at $1 million, that's $1 million asset that I need to list on the FAFSA form. Well, then essentially you don't own it then, right? You know, if I owe the bank $1 million and the property's only worth $1 million, then I don't, it's not it's not a line item as an asset that I have. But that's not a great situation, to be honest. If you, so you definitely got problems if you owe more than what it's worth. So just to catch you up on what I just said, sir. So 3 different options for loans. We're going to get into each 3 now: private loans, government loans, and then what are called permanent life insurance loans. These are the easiest. The private loans, it's like any other loan that you go to a bank, negotiate a term and an interest rate with the bank. If you have, they're going to obviously review your credit. If you have good credit, you're going to probably have a better chance of getting a loan than if you have poor credit. And that's really it. Government loans are much more complicated. That's what this young gentleman was just asking about. It does take into consideration your income, your assets, things like that. It's important to note that if you've done a good job saving with a 529 or investment accounts for your child that will count against you in government aid that you could potentially get. All right, so if you have 125,000 in a 529, you're going to have to put that down on your FAFSA form, and they're going to take that into consideration on whether or not you're eligible. Right. I'm going to go through what I'll tell you guys is I'm going to go through the high level of this over the next several minutes. It could be a whole nother 3-month class that just talks about government law. It gets very, very intricate. So high level is what we'll stick to today. Let's first talk about the permanent life insurance option. This is probably one of the more unique ways to fund school, fund tuition educations, but it could be very, very impactful if it started early enough. So not to turn this class into what life insurance is, but there's financial products out there that are called permanent life insurance. And what that means is that if I have a permanent life insurance policy on myself, whenever I die, whether that's tomorrow, God forbid, or whether that's in 40 years, whenever it is, the insurance company is going to pay a death claim to my family, and that death claim is going to be tax-free. And if you think about it, from an insurance standpoint, how do you insure against an event that 100% is going to happen? Right? So when let's say we all own homes, right? And I get a homeowner's insurance policy, it's going to cover in case my house burns down. The insurance company is banking on the fact that it's very unlikely that my house is ever going to burn down, right? But to get permanent life insurance, there is 100% certainty that I am going to die, right? We just don't know when. So from an insurance standpoint, it is a very unique kind of event, if you will, to insure against. So because of that, these unique financial products have been rolled out over the course of time. And permanent life insurance has a second component to it that not only does it pay a death claim whenever you die to your family, but it builds what's called cash value. Think of it like a savings account inside the life insurance policy. And that savings account has a lot of favorable tax treatment to it. And so a lot of folks, sometimes they take out life insurance policies on themselves, or they take out life insurance policies on their children, permanent life insurance, right? Not term insurance, permanent. It's a very, very important distinction. And as the cash in the policy builds over the course of years, they can take loans against that cash value to pay for tuition expenses. I think one of the reasons why a lot of folks like this is because none of the cash in the life insurance policy can be counted against any government assistance. So if you fund a 529 or you fund an investment account for your child, and then you go to apply for FAFSA and they decline you because you have too many assets, they cannot decline you because of any of the value you have in your life insurance. You could have millions of dollars in your life insurance policy and still qualify for full government aid because it's not something that they can take against your eligibility. That's a whole nother class. The short version is, so think of it like a mortgage. You might not be too familiar with a mortgage, but when you pay a mortgage in the beginning years of the mortgage, like let's say my mortgage is $3,000 a month. The first mortgage payment I make, like 2,700 of that $3,000 goes to the interest to pay back the loan, and 300 goes back to principal. But over the course of the 30-year mortgage, the ratio of how much goes towards equity and how much goes towards interest slowly starts shifting. The life insurance policy is the same way, where in the beginning years of the policy, the majority of the premium goes towards the cost of insurance, and a small piece goes towards the cash value, the savings account, right? But as time goes on, that ratio changes and more cash gets built into the policy. On top of that, the insurance company usually issues what are called dividends. They're typically not guaranteed, but almost every single insurance company has issued them every single year. And so not only is part of the premiums being saved contributing to the cash value, but then every year, if the insurance company is doing well, they're issuing dividends, and that's also then compounding the growth of the cash value. It's not, I'm going to say, not a straightforward way to do it, but if it is done right for the right person, it's not a good fit for everybody. It can be very impactful. Let's talk a little bit more about it. So I already said this, it provides death benefits, permanent life insurance, so it provides a death benefit. So the other nice feature of it that I think people like is, well, God forbid something happens to me. I mentioned, I'll talk about my own situation. I have a 4.5-year-old daughter. If I have life insurance on myself and I'm going to potentially use some of that cash in the life insurance policy in 14 years to pay for my daughter's education, another benefit of this is that if, God forbid, I don't come home from work tomorrow, my family also gets a tax-free death benefit from this insurance that could also be used to pay for my daughter's education. So it helps protect my family as well. So it's, there's a few benefits to it. It builds cash value that accumulates tax deferred. So every year that cash value is growing, you don't have to pay taxes on it. Cash value can be used to limit student loan exposure or pay for non-qualified education costs, is what I said before. They can't use the cash value in the policy to decline you for FAFSA. Policy loans require no application, no collateral, and no fixed repayment schedule. So this is the other reason why people like it, is because if let's just say I have $100,000 in cash in my life insurance policy, if I want to take a loan against that 100,000, I basically fill a form out, and 2 business days later, I have the money. There's no looking at my credit. There's no underwriting process. There's no government, there's no looking at my assets and income and my businesses and real estate. It's my money and I can take it out like that. So as opposed to, applying for a government loan, which can be a very, very rigorous, detailed process. And that's pretty much it on the life insurance. Any questions on that before I move on to the next topic? Yes, sir. So it's a little tricky. It's a tough question to answer because of the complex nature of how permanent life insurance works. A good amount of the time, if the loan is structured correctly, and as long as the policy has enough cash in it, a lot of times those loans are never repaid. As long as there's enough cash in the policy after the loan is taken. So I'll give you an example. Let's say I have $100,000 in my policy. If I take a $90,000 loan against that and never repay it, that policy is probably going to crash over the course of time. It's too big of a loan for the value. But if I take a $30,000 loan or 40, or maybe even a $50,000 loan against that, it's possible that the policy can absorb that loan over time and I'll never need to pay it back. So it's a complex kind of calculation that needs to get done, and you would need to work with an expert who's very familiar with how these financial products work, and they would be able to essentially guide you and say, hey, look, here's the amount, here's kind of a safe zone that if you took a loan of this amount, no guarantees, but there's a good chance you won't have to pay it back. Or if you do have to pay, you might have to only pay minimal amount back. Versus if you get into a more dangerous zone, if you take too much money out, now you're in a position where, you could collapse the policy. Hopefully that gives, I know it's not a straightforward answer, but. Good, I'm glad it was helpful. Any other questions? Okay. So let's go on to the next topic. FAFSA. All right. So FAFSA is a free online application that determines an individual's eligibility for federal financial aid. The aid offered through FAFSA includes government loans, grants, and a work-study program. Let's talk a little bit more about FAFSA. Social Security. So here are all the different things that when you go to fill out a FAFSA form, the government's going to require all this, and they want documentation. You're going to have to show Social Security and driver's license numbers for parents and children. You have to be a U.S. citizen. Federal tax returns and W-2 forms. So you're gonna have to attach your tax returns and any income, any of your W-2s, or declare any income that you have from businesses and rental properties. Your total household income, including any untaxed income such as child support. They want to see it all. Information on all bank accounts, balances, cash, etc. Information on all investment accounts, real estate, excluding primary residence, and business interests need to be declared. And number of household dependents. So you gotta kind of hand over a good amount of information. How does it work? The information you submit determines your what's called expected family contribution, known as EPC for short. Your EPC is a number that determines the amount of aid your child is eligible for. So typically how the process works is, all that documentation that was just mentioned, that gets uploaded to the FAFSA website, goes to FAFSA. They spend several weeks, sometimes months reviewing it. And then they usually send their information to whatever school you're applying for. And that school then reviews it, and they'll couple any financial aid that they may be able to offer as well. And then the school will come back to you with basically saying, here's how much financial aid you qualify for between the government and what we can do. Here's what you're getting. Yes. So think of it like two different financial aid packages. FAFSA, the government will say, here's how much we can offer you. And then the college may offer you extra on top of that. And then they couple the two, and that's what your offer is. So you might receive a total of $10,000 a year in financial aid, and maybe 8,000 of that is from FAFSA and 2,000 from the school. Yes, that's actually one of the next things. You do have to apply every year, because what they want to see is that if you win the lotto next year, they want to see that, and then they're going to probably say, sorry, you're wealthy now, and there's people of need that need it more than you do. So how does FAFSA work? There's what's called direct subsidized loans and direct unsubsidized loans. I'm probably not going to get too deep into this, because this is kind of one of those things where it gets almost into the minutia too much. But with the direct subsidized loans, they're available to undergraduate students with financial need. The unsubsidized loans on the right can be for undergraduate as well as graduate. That's one of the bigger differences. The school determines amount you can borrow, may not exceed financial need. It's the same for the unsubsidized. Excuse me, for the subsidized, the U.S. Department of Education will pay interest while you're in school. For the unsubsidized loan, you're responsible to pay the interest at all times. So that's really the biggest difference between subsidized and unsubsidized is, are you going to have to pay interest while you're in school, or is the government going to take care of that? Second. Yes. Yeah. Yeah. They're essentially just helping you while you get on your feet. So let's talk about more FAFSA programs. We'll talk about Pell Grants and work study. So Pell Grant, it's a grant that does not have to be paid back, right? It's typically around $6,500 a year. So it's helpful, but if you go to a private school that's $50,000 a year, the impact is limited. It is competitive. It's definitely very competitive. A lot has to go into applying for that grant. There's a lot of people that apply for it every year. Select people get approved for it. But if you do get approved through a very detailed process, you get around $6,500. Then they have what are called work study. You are given the opportunity to apply for jobs on campus. Payment is intended to help you cover expenses. So essentially, it's something that the government kind of teams up with the college and says, look, we're going to give favorable employment opportunities to kids that qualify for work study, because these kids, they really need, the employment, and this can kind of help them pay for some of their costs. So it's just essentially a way that you can kind of easier path to getting a job while you're in school. So that's it as far as the loan options are concerned. Before I get into the final piece of today's class, any questions with this? Yes. Absolutely. Absolutely. You can get a job wherever you want, anywhere you want. It's just not going to be correlated to any kind of financial aid or anything like that you may qualify for. Okay. So options for decreasing costs. Consider various ways to decrease annual costs. So one of the most common ways is what's called a credit transfer. So we might have all heard that maybe for the first 2 years, you go to a community college, right? Which is, pretty inexpensive. And then you transfer those credits to a 4-year institution that might be a lot more expensive. But what did you just do? You essentially just cut the cost of the 4-year education in half. But at the end of the day, you still graduated from ABC 4-year institution. You still have the diploma on the wall from that school. And, on your resume, it's still listed you graduated from this school, but you cut the costs in half. So a lot of folks do that. So if I'm like a 16-year-old and I just got accepted to Harvard, and I decide to go to Suffolk to save money, I would have to reapply to Harvard in 2 years when I'm done with my associate's degree at Suffolk, and they would have to reevaluate me at that time. So there's no guarantee that you're going to get into it, because if you went to Suffolk and you flunked, for 2 years or got D's all 2 years and barely graduated, Harvard's obviously going to, consider that. But it also works in the reverse, sir, where there are cases where students, maybe they didn't get into the school they wanted to, but then they go to community school, they work really hard, they get excellent grades. And now the 4-year institution is looking at those grades that they received the last 2 years, and, they can potentially look more favorable. Yeah. 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 I would say so. And, look, off the record, right, unrelated to today's class, I would tell certainly, any 16-year-old that got accepted to like an Ivy League school, I think that kind of top tier school. I know if my daughter got accepted to an Ivy League school, I think that's worth every penny, because the education and the doors that's going to open for her are going to far outweigh whatever the cost may be. So that's something you also got to take into consideration. Yeah, that's more of it. Yeah. But, I think, and I'm certainly not, I don't work on the college admission board. So, take what I'm saying with a grain of salt. But I think if you got accepted to a state school at a high school, chances are 2 years later after community school, you're probably going to still get accepted to it. Right? You can't flunk through the next 2 years of community school, but chances are you're going to do just fine, and, you'll be able to get in. So that's for that reason. That's why a lot of people do that first one, which is a credit transfer to save some money. The second thing that you see there is a degree in 3. This is challenging, but for kids that really have a phenomenal work ethic, if you can take extra classes, you can take classes in the summer, you take classes over the winter break, right? Maybe you took some AP classes in high school, so you got a jump start on some college credits. You graduate in 3 years as opposed to 4 years. Well, you just cut the, instead of paying, for 4 years of school, you only pay for 3. Do you have a question? Oh, scholarships, right? Obviously, if you can qualify for any scholarships at schools, whatever they may be, that could be very impactful for the cost of education. Residency change, right? So what this means is, let's say I live in New Jersey and I really want to go to SUNY Stony Brook, right? But the tuition is almost double because I'm not a New York State resident. But let's say my aunt lives here in Hop Hog. Well, maybe I decide to move in with my aunt on paper, and now I am a resident of Hop Hog, and now I can go to SUNY Stony Brook and get New York State. Yeah, works. I honestly, I will admit I am not an expert at that. I just know people do it. Yeah, sounds about right. Sounds about right. But, sometimes people, maybe you go to a community school and then you change residencies and you do that. The point is that, and it doesn't also mean that you can't go to school, pay the higher tuition costs for the first 2 years, and then declare your residency in that state. And for the latter 2 years of your education, qualify for the in-state. So, but you need to, you can't just make up an address. You have to have somebody that you can legitimately declare your address on. You're going to have to file tax returns. You're going to have to have bank accounts. I mean, really, you have to, that has to be your residency. So your driver's license and everything has to be tied to that address. So, you know, it's not as easy as just saying, hey, I'm gonna, you know, write down my aunt's address and no problem. You really do have to change it. But there's plenty of people that do that, and you know, maybe they still go back to their state of residency during, you know, when they're not in school, and that's fine. And then other expenses, right? Which is just, you know, essentially what this is saying is that, you know, try to cut down on your other expenses so that you can afford, you could either save more or pay more to tuition, is all it's saying. Right? Yeah, easier said than done. Absolutely. So in review, I think a good place to start is to research the costs of preferred schools. There's a huge range between an in-state public school and a private school. Huge range. I mean, this is almost three times the cost on average. So determining, well, where do I want to go to school, right? And I think what a lot of kids don't do, because, and I know I didn't do it when I was 16 years old, because, you know, I didn't really think about money at 16. I think, you know, making sure that the teenager and the child are factoring that into the decision, right? And making sure that, you know, tuition education cost should play a factor in what schools I apply to and which ones I don't apply to, right? So what this can do is now it can at least give an idea of saying, hey, here are my top 3 schools. Here's what the cost is going to be. And we can at least start working within a budget to know how much are we looking at committing to education. Set savings goals. You know, look, the earlier you start saving, the more impactful it's going to be from an investment perspective. You know, I've seen it happen a million times. Parents that start saving for their children's education when they're newborns versus kids that start later. The ones with newborns, even if it's a small amount of money that they put away on a monthly basis, over time, that money compounds. Investments perform well. The money compounds, and it could be very, very impactful, but you need time. Too many people kick the can down the road. Too many young parents specifically kick the can down the road, and they wait too long to save. The earlier you can do it, the better. Consider funding via the rule of thirds, right? It's not that any one of these options is better than the other. And for most folks, they do all 3. Most folks, they save money, they take out loans, and then they pay some out of pocket while the child's in school. Make sure to take advantage of all financial aid and scholarships. So this is a difficult process to apply for FAFSA and try to apply for scholarships, but at the end of the day, it's free money. So absolutely, you know, take the time, right? If I'm going to work 40 hours a week and I'm going to get paid X amount of dollars, if I can save $10,000 a year, is it worth me putting 20 hours into looking into a FAFSA form? I think so. $10,000 for 20 hours of work is not a bad hourly rate. Seek guidance. You know, where I come into play is, you know, me as a registered financial planner, my expertise is on the financial side of things, on the investment side of things. So I help folks set up 529 plans all the time. I help folks set up investment accounts all the time. I help folks set up permanent life insurance solutions to pay for college. I help just do general financial planning with clients to, you know, figure out the best way to pay for something like college. But there's also other professionals, and this is not something that I am, that specifically all they do is look at college. And there's even professionals that are experts on FAFSA and experts on getting scholarships. And, you know, their businesses that you can pay them a fee and they will essentially help guide you on the best path to qualify for as much scholarships and as much financial aid as possible. So it's not a bad idea to seek guidance from these professionals. And that's it. This is my information. Is there any questions that you guys have for me? Okay, excellent. In the folder is the presentation from today, like I said. So everything that was displayed today, you guys have hard copies of that information. I also included a seminar evaluation form in there. If you guys wouldn't mind just taking a moment and filling out the evaluation, it's very helpful for us, you know, to hear back from you guys to see what you liked, what you didn't like, if something wasn't talked about today that you wanted to talk about. So if you wouldn't mind taking a moment to fill that out and give it back to me, that would be great. And that's all I have for you folks. Well, I appreciate your time, and I'm gonna stick around for a little bit in case you do have any questions you don't want to ask in front of everybody. That's perfectly fine. That's no problem. No problem. Appreciate you guys coming down. Good luck to you.